Let's talk about the pros and cons of buying down your interest rate versus paying off debts, especially when it comes to mortgage pre-qualification. So, as lenders, we look at your debt to income ratio. What this is your gross monthly income versus the debts, your monthly debts, your money going out versus your money coming in. So buying down your interest rate or buying down points basically just buys down your rate. So you spend a few $1,000s to buy down maybe a quarter of a point. So versus paying off debt where you could actually increase your affordability. So that's what we're going to talk about. So the first scenario is short term, short term debt, high payment, affecting your debt to income ratio. What we're talking about is a debt, say a car loan, installment loan from somewhere. It's costing you $450 a month. That goes against your debt to income ratio, decreasing your affordability. So the points alternative is putting that same, say you have $5,000 of disposable income. Do you want to buy down points? So you say, oh, I'm going to buy down points. That could, and you buying down, spending $5,000, say on a $200,000 loan, buying down your rate would probably drop your payment $40 to $50 a month. But giving that $5,000 and actually paying off that $450 a month of debt is going to give you probably about another $50,000 to $60,000 worth of buying power versus you dropping your payment $80. So that's going to help your affordability. It's going to help your approvability, etc. So the winner is always going to be, in that case, paying off the $450 a month debt. So we'll have to count that against your debt to income ratio, making your loan approval easier, your purchase price, your loan amount larger. If that's what you want, it's going to fix a lot of things. Situation number two, debt to income qualification, you're borderline or you're over the limit. So in this case, same thing. Your DTI is at 50% or 45%, depending on conventional. And then you're like, hey, I'm trying to qualify, and someone says, hey, you can buy down your rate. Instead of taking that money out of your savings or anything else and trying to buy down your rate to get affordable, we want to look at your credit report, see what debts that you can pay off to put you back in the acceptable guideline and the ratios for the program that you're looking for. Again, paying down points lowers your payment by a tiny fraction. And I say tiny fraction because I'm talking in regards to, in comparison to what you're putting down. $5,000 isn't going to lower your payment. Isn't going to lower your payment by $500 a month. So in that case, you have a $300,000 worth of credit card bills, paying those credit card balance $300 a month of credit card balances, and they're all equal up to about $5,000. In that case, paying off those $300 worth of those credit card balances that equal $300 a month is going to help your affordability, help you qualify. So in that scenario, then you don't have to count those monthly payments against your debt to income ratio. Again, you're winning with that. Buying down the rate is not a short term plan. If you're going to pay and buy down your interest rate, you really want to do this and plan on being in that loan for a while. I would say 5 to 7 years, because buying down the rate usually takes time to break even. There's a break even point with anytime you do a refinance, buy down rates. Anytime you pay more points than the par rate, it's always a break even point. So that's something you want to get with your loan officer, preferably myself, and try to figure out when you're going to be the break even point, if that's going to be worth it. If you're only going to be in that house for 5 years, it may not be worth to spend that money to buy down the rate. So usually it's going to take 4 to 7 years minimum for that rate buy down to go in effect and for you to see those savings. So if you plan on the refinance in 3 to 5 years, there's no need to buy down the rate. Pay off some other debts, give yourself, reduce your monthly outflow of cash, and just take the rate that you get, and pay down some other things. Because all you're really looking at in the end is how much money I'm spending out. You're like, okay, I got my mortgage at 2,500. I got this car note at 600. These credit card bills at 300. So if you take off one of those monthly debts, it increases your affordability. It's the same amount of money. Plus, on the mortgage, at least that interest is a write off. It's not as where those other debts are. So the golden rule is, if you're if you're going to buy down your rate, first of all, make sure it's a seller buying down your rate and not you. And then, but also check to see if you getting rid of some monthly liabilities is going to be a better option for you. So if you have any questions about your personal scenario, you can reach me at 404-461-3172 or reggieloans.com. Talk to you soon. Bye.